Tax Planning Fundamental, Part 2. Disclaimer: this document does not constitute tax advice. For specific tax-related questions, please consult a tax professional. Introduction. As highlighted in Part 1 of Tax Planning Fundamental, under direct income tax, the formula for direct income tax is income tax equals to income less deductible expenses, then multiplied by the tax rate. For taxpayer to minimize direct income tax, its focus should be on 1. Reducing taxable income, 2. Maximizing deductible expenses, and 3. Optimizing the tax rate. Optimizing tax rates means shifting from a higher to a lower tax bracket. This video mainly deals with shifting income from a high-tax jurisdiction country to a lower-tax jurisdiction to create more tax savings from the tax rate differential. Let us now look at the effective corporate income tax rate for the U.S. tech giants: Apple, Google, Meta Platforms, Microsoft. As shown from the overview of the effective corporate income tax rate payable by the U.S. tech giant, it is notable that between 2017 and 2020, the effective corporate income tax rate ranged from 8% to 16%. In 2014, the effective corporate income tax rate ranged from an astonishing 0.005% to 10%. The 0.005% effective corporate income tax rate was recorded by Apple in 2014. However, from 2021 to 2022, the effective corporate income tax rate has increased, ranging from 9.7% to 15.8%. The increase in effective corporate income tax rate from 2021 onwards was largely due to the introduction of the global minimum tax, which is officially known as the OECD or G20 Inclusive Frameworks Pillar 2. The global minimum tax was first introduced in October 2021 by the U.S. Biden administration. The focus of this video is to identify the cause of lower income range prior to 2021. Before proceed any further, it is important to understand the every single percent of tax savings. Take Apple Computer as an example. In 2014, Apple reported a profit before tax of $53.5 billion. Therefore, a 1% tax saving is equivalent to $535 million. In 2014, Apple's effective corporate income tax rate is 0.005%. By applying 15.8% effective corporate income tax rate in 2022 to profit before tax in 2014, Apple should have paid $8.45 billion. This means there was a tax saving of approximately $8.45 billion in 2014 with an overall effective corporate income tax rate of 0.005% payable by Apple. It was also because of this astonishing low tax rate, Apple was under the investigation by the European Union. How did the U.S. tech giants did this? Companies need to pay CIT when they make a profit. Below is an illustrative example. Company A is a company incorporated in the U.S. It sold product A in Canada for $1,000. Product A was made in several countries such as Japan, China, the USA, South Korea. How Company A pays tax and how much tax is to be paid in these foreign countries depends on the value added to the product line. See below example. Part A to Part D are parts assembled by factories incorporated by Company A in the respective country. For example, a factory in South Korea made Part A of Product A and was entitled to a service fee of $200. $200 is the first cost embedded in Product A. With the same pattern, profit were created in different countries with value created by different country. Therefore, when Product A reaches Canada, it's a final product, and its total cost is $900. Canada sold the final product for $1,000 and made a $100 profit. Since combined corporate income tax ranges from 26% to 31%, which gives an average of 29%, the corporate income tax paid by Company A in Canada is $29. Total corporate income tax paid by Company A for selling Product A is $255, being the sum of all corporate income tax payable by Company A in different countries. It is critical to understand since corporate income tax in different countries is different, the gray area is very large to adjust the profit created in different countries. The gray areas in this aspect are characterized by the key challenges associated with the above-mentioned value chain in the course of determining the appropriate amount of value created in the respective countries. These key challenges are: 1. For governments in different countries, how does the government determine the value created in each country? 2. The key challenge one was further complicated when subsidiaries or affiliates in different countries also deal with one another. 3. The tax law is different in each country and corporate income tax in each country is different too. Because of these challenges, the maneuvering space is large. Company A in this illustrative example is clearly a multinational corporation with key functions such as research and development, production and manufacturing, head offices, sales and marketing, and other key functions present in different countries. Therefore, Company A can utilize the relevant local tax laws to minimize its tax liabilities. The cost for Company A is a need to employ a group of elite lawyers and accountants through different countries in which Company A has offices or conducts business transactions with. Whether it is cost-effective to employ these professionals in different countries depends on how much tax can be saved and the scale of the tax savings. As highlighted above, take Apple as an example. In 2014, Apple reported a profit before tax of $53.5 billion. Therefore, a 1% tax saving is equivalent to $535 million. So, this tax saving is more than sufficient to hire these professionals in countries in which Apple has offices and key functions present. Step 1. Minimizes tax in head office, U.S. worldwide taxation system. As mentioned above, Company A is originally incorporated in the U.S., and its head office is also based in the U.S. Under the territorial tax regime, all domestic income generated by Company A is subjected to the U.S. tax jurisdiction. One special key feature of the U.S. tax system is its worldwide taxation system. The core principle of this system is the U.S. taxes its citizens, residents, and domestic corporations on global income. Company A has key functions in many countries, and regardless of where this company is making a profit, its profit is subjected to tax in the USA. Likewise, if the shareholders of Company A are American residents or green card holders, their foreign incomes have to be reported to the tax office of the U.S., known as the IRS. However, there is an exception. As long as the taxpayer does not bring the profit back to the U.S., the taxpayer is exempted from paying tax in the U.S. In other words, Company A, as long as parks its profit in foreign countries without bringing it back to the U.S., its foreign profit generated can avoid paying taxes in the U.S. Step 2. Minimizes taxes in foreign countries. Excluding Ireland. Company A relies on Step 1 to minimize its tax exposure under the worldwide taxation system of the U.S. However, the profits generated by companies incorporated in foreign countries are subjected to the domestic tax of the respective country. Company A can minimize its foreign corporate income tax liability by first, locate a country with a low tax rate with suitable conditions in every aspect. Then, followed by finding a way to move most of their overseas revenue into this country. Step 2.1. Identifying a country with a lower tax rate. For the illustrative example of Company A, we chose Ireland. Ireland's corporate income tax is 12.5%. This is under the assumption that the OECD global minimum tax of 15% is not applicable. 12.5% corporate income tax is significantly lower than all other countries such as the US, China, South Korea, Japan, and Canada in which Company A has key functions present. Ireland is therefore an ideal choice for Company A to park most of its profit. However, there are tax haven countries such as the Virgin Islands, Cayman Islands, and Bermuda, where the corporate income tax rate is 0%. However, tax savings may not be the only consideration. Assuming Company A is a listed company in the leading stock exchange in the U.S., and therefore, safeguarding its reputation may outweigh tax savings consideration. Company A may be a leading producer of product A in the world, and putting its foreign head office in a black box country such as a tax haven country will harm the reputation and branding of the company. Therefore, Ireland is a good choice for Company A. However, for other companies, tax haven countries may be a better choice, and it largely depends on commercial and tax savings considerations. Step 2.2. Upon selecting Ireland as a country of lower tax jurisdiction, the next step is to move the profit from other countries to Ireland. The total revenue generated by Company A for selling product A in the Canadian market is $1,000. Assuming the total cost of producing product A is $600, its profit before tax is $400. $400 profit will be subjected to tax in Canada. Company A has invested substantially in its intangible assets such as intellectual properties. This means a large amount of value in $400 is created by these intellectual properties. Therefore, paying $400 profit in Canada is not reasonable. Company A has its intellectual properties owned by its company incorporated in Ireland and would charge Canada company royalties on these intellectual properties rights. For example, with $400 royalty charge, this will wipe out the entire profit of $400 which was to be paid to Canada. Furthermore, Company A can adopt the same principle of charging all other countries royalty fees in addition to Canada. This way, all profit will be captured and parked under Ireland. However, there is a key obstacle. Assuming 95% of the research and development that creates the intellectual properties of Product A is done by the research and development team in the U.S. So how could Ireland Company collect this royalty payment since Ireland does not develop the intellectual properties? The solution to overcoming this key challenge is for Company A to create a cost-sharing agreement. Under this agreement, the Ireland Company pays a U.S. company for research and development service in return for owning the intellectual properties. Upon obtaining the ownership of the intellectual properties by Ireland Company can then collect royalty payments globally. In other words, the U.S. office of Company A is merely a research and development service provider. Company A's office incorporated in Ireland is the final owner of the intellectual properties created under by the research and development team in the U.S. Step 3. After most of the profit from companies in different countries are centralized in the Ireland office of Company A, the next step is to find ways to reduce tax liabilities in Ireland. In Ireland, there remained a 12.5% tax rate that was required to be paid by Company A incorporated in Ireland. There is a loophole in Ireland's tax law. Generally, Ireland tax regime follows a territorial tax. The general principle of this tax regime is any profit generated by a company incorporated in Ireland and sourced inside of Ireland is subjected to corporate income tax of 12.5%. However, for Ireland, things are different. Ireland only imposes tax on foreign entities that set up its related entity inside of Ireland based on I, who manages a company, and 2, who controls a company. This refers to controlling party. To take advantage of this loophole, Company A can set up a foreign company, for example in Bermuda, to manage and control its company incorporated in Ireland. Therefore, the Ireland's controlling party is outside the tax jurisdiction of the Ireland government. With this structure, Company A can avoid the tax in Ireland. Surely, the actual structure is a lot more complicated. It requires the setting up of several companies in Bermuda, the Netherlands, Ireland, etc., and through the use of multiple agreements to fulfill each country's tax requirement. Step summary. Company A minimizes its corporate income tax through the following steps. Step 1. Through the cost-sharing agreement, Company A made Ireland's office to own all major intellectual properties of Company A. Step 2. Through the use of intellectual properties registered in Ireland to charge royalty fees to other entities of Company A located in different countries. This ensures profit from all countries is centralized in Ireland. This way, entities in other countries do not pay any local tax. Step 3. Because the money is not shifted back to the U.S., Company A can also avoid paying taxes in the U.S. Step 4. Because the Ireland office is managed and controlled by a controlling party located in Bermuda, which is outside of Ireland's tax jurisdiction, the Ireland office does not need to pay any corporate income tax in Ireland. The above-mentioned tax planning strategies, principles, and steps were used by U.S. tech giants such as Apple Incorporated, Microsoft, Google, Amazon, and Meta Platforms, Facebook, for global tax liabilities. Why doesn't the government of Ireland close the tax loophole? The question arises as to why the government of Ireland does not close the tax loophole. Ireland's government is well aware of the tax loophole in which these foreign multinational corporations in Ireland did not pay any tax. However, the Ireland government allows these foreign companies to do so because it creates a large demand for employment and talent. In Ireland, 25% of employment opportunities are provided by American companies. From 2014 to 2023, the foreign direct investment of Ireland increased from $3.245 trillion to $7.315 trillion, with the U.S. multinational corporations being the dominant foreign investor. The 2023 GDP for Ireland is €533 billion. Therefore, The foreign direct investment to the gross domestic product ratio for Ireland in 2023 is 1,256%. OECD Global Minimum Tax. Organization for Economic Cooperation and Development, OECD, is an international organization founded in 1961, comprising 38 member countries, primarily advanced economies. Its mission is to promote policies that improve economic growth, social well-being, and global trade while fostering sustainable development. The above-mentioned tax planning strategies are commonly adopted by many multinational corporations. However, with the introduction of the OECD Global Minimum Tax, which aims to curb tax avoidance by the multinational corporations, the general effective corporate income tax rate has increased. Some concise summary of the key impact of the OECD 15% global minimum tax are outlined as below. 1. Loss of 0% rates. Jurisdictions like Bermuda or Cayman Islands must impose a 15% top-up tax on large MNCs with total annual revenue of more than 750 million euros. Meaning the former 0% tax haven state is no longer applicable to multinational corporations with turnover of more than 750 million euros. Likewise, Ireland can no longer able to offer 12.5% rate to multinational corporations like Apple since Apple's turnover is clearly more than 750 million euros. 2. For the multinational corporations in the US and European, the effective corporate income tax rate has increased. For example, Apple's rate rose from 0.005% in 2014 to 15.8% in 2023. As for Google and Meta, they now pay 11% to 15% in general, as opposed to 6% to 10% pre-introduction of global minimum tax rate. Furthermore, the initiatives of shifting profit to Ireland or Bermuda subsidiaries have reduced. 3. For corporate strategies, some multinational corporations have shifted their research and development functions to countries with substantial activity exemptions. Likewise, in term countries that own the intellectual properties, there is less incentive to park the intellectual properties in the tax havens countries. Conclusion: strategic tax optimization enables businesses, especially small and medium enterprises, to enhance profitability, ensure compliance, and reinvest savings into growth. There are key competitiveness for multinational corporations in their tax optimization strategies. For example, multinational corporations could leverage their global presence, local expertise, and regulatory insights to maximize tax efficiencies. Therefore, it is a good model from which small and medium enterprises can derive valuable lessons. The core principles which we can obtain from the multinational corporations for tax efficiency objective encompass: 1. Dynamic compliance and monitoring. This means that tax laws evolve continuously, and therefore, static approaches are ineffective. A dedicated team or a person is required to ensure compliance, optimize savings, and mitigate penalties. 2. Proactive cross-border strategies. Small and medium enterprises are recommended to adopt scalable, jurisdictional tax tactics, even incrementally. 3. Investor-centric tax governance. For small and medium enterprises to have a strategic tax adaptation will enhance their company valuation and attracts premium investment. Furthermore, the geographic diversification will also strengthen stakeholder networks and market access. As a conclusion, tax optimization initiatives are highly recommended to be adopted by small and medium enterprises. These initiatives could benefit the enterprises via reducing effective tax rates, minimizing compliance risks, and positioning themselves for scalable growth and funding opportunities. As a whole, tax strategy is no longer just about compliance, but it has evolved to a competitive lever. Small and medium enterprises that embrace agility and jurisdictional awareness can close the gap with larger players. Thank you for taking the time to watch this video. We trust it has provided you with a foundational understanding of tax planning. We would greatly appreciate your feedback and are always eager to hear from you.